India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel D'Souza, and joining me, Surbi and Sonia will be with us in just a bit. It's a rainy morning here in Mumbai, and it's going to be a bit of a tricky day, not just for the markets, but also on the weather front. Hey, Surbi.
Good morning, Nigel. You know, there are some mornings, some days, you're just glad you could make it. It's a near small miracle, but I think very thankful for the fact that we are here. Our teams are here, people who are bringing the show to you. We are all here, and we will report on the markets as usual. But yes, Mumbai, please be safe out there because it is a very turbulent morning. And actually, it's a very interesting setup for our markets as well, because you've got the global cues on one side. And Nigel, before we talk domestic markets, I just want to pull that up. Look at what's happened to Wall Street. There's a lot of sector rotation that's playing out over there, because if you just look at the different indices, big tech sold off big time yesterday. So the Nasdaq was down. That had its part on the S&P 500, which also ended lower. The Dow was flat. There's one index, however, where all the money was rushing to, and that's the Russell 2000. So the money moving from, big tech, those big, mega, magnificent 7 stocks, going to small caps. The reason why that happened was because of the inflation report that came in. But I'll talk about that in more detail as we go along. Short point is that, global cues are a little wobbly. But for us here, we have a very big positive cue in the form of TCS. More on that as well as we go along. But interestingly poised, Nigel, on the market, because, we had the banks recovering yesterday. There was some consolidation on the Nifty. I guess, what's your sense? How do we start?
Well, that's right. It's going to be a bit of a tricky start to the trading session, and we'll have to see how we go from there as well. It's going to be quite important, but let's run you through a couple of cues then on that front itself. Looking at the long-short positions, basically, in yesterday's trading session, there was some unwinding of longs, and that's what we saw in the previous 2 trading sessions as well. So that's going to be one of the data points that we focus on even in today's trade. Let's get that data point up for you. Longs down by close to 27,000 contracts odd. You have the position that's come down to around 78%. Let's pull up the absolute numbers. And what's happened is we have been talking about the FIs being net long, and they're going, a little bit full tilt on that side. Now, that's reduced a little bit because the net long contracts have come down by close to around 80,000 contracts, if you look at it in this week itself. And we've been talking about the clients, they have been net short. I'll tell you what, they have covered their short positions as well by around 80,000 contracts. 2.8 lakh contracts, that's come down to closer to around 2 lakh contracts odd. So both of them, that data point is converging a little bit. I want to see some shorts in the system, particularly from the FIs, because that's what gives us a case to see a bit of a short covering bounce. Then it appears there's a strategy going on. A short straddle is likely to be taking place to 24,300 call, 24,300 put for this contract that's going to be expiring. And if you just look at the premium between the two, it's roughly around 250 to around 300 rupees odd. So pocketing that 300 rupees, plus 24,300 and minus 24,300. The near-term levels, that's important. You have the resistance that comes in at around 24,500 odd. And the recent highs as well are closer to that. So the 24,500, that's the line in the sand. If you get past that, you get a little bit more optimistic. And then you believe that we're in for the next leg. For the time being, this is a bit of a resistance zone that we're looking at. In terms of support, every time we go to around 24,150, as we have seen in the last week or so, we see a bit of a bounce. If you want a reference point, well, the support level comes in at around this 24,100 odd. Now, let's focus on the Nifty Bank, because that's very, very close to the 20 DMA. Yesterday, in fact, it briefly just, came below that, and then it bounced from there as well. So the Nifty Bank holding on to this 20 DMA, that's very important. And if it has to do that, then HDFC Bank comes into play. It went dancing away to around 1,800 odd, but it corrected close to around 10%. And yesterday, it went down to around 1,600 odd, which was an important level. So in the last 1 month, it's still up close to around 4%. But if you look at it from the peak on that MSCI, news day, from there, it's corrected close to around 10%. So that's going to be rather important. This one as well is hovering around the 20 DMA. Finally, the 2 indices that we'll be focusing on in trade today. One will be obviously the IT index, because we have TCS's numbers that were pretty good. The index has been outperforming. You have the tailwind coming in because now you start factoring in some global rate cuts as well, going by the Fed futures tracker. And the metal index. When you talk about rate cuts, both these two indices are in focus. The tech space has the additional kicker because of TCS. What else,
yes, absolutely. Tech is a space to watch because, it's not just a, couple of basis points beat here and there, even the commentary, and we'll get to that. We'll hear more from the TCS management as the show progresses. But for the timing, I'm just dialing back to the point on Wall Street and why was this huge tectonic shift away from the Magnificent Seven towards the small cap? It's because of the inflation numbers that came in. Remember the jobs report on Friday? That gave the market some hope that rate cuts indeed will happen. Now you have a soft consumer inflation print. So let's pull up the numbers. That headline CPI number was actually down 0.1%. So there was no inflation. There was a degrowth. There was a decline that happened versus estimates of a minor increase, 0.1%. If you look at core CPI, again, the growth there was just 0.1% versus estimates of 0.2%. And that led to a massive drop in yields as well. The US 10-year yield was down to a level of below 4.2% during the intraday action. We haven't seen that since March. That was a pretty big move in yields. In fact, we've got the yield up. It's back above the 4.22 handle, but there was a lot of drama playing out in yields on the expectation that we're going to get those rate cuts from the US Federal Reserve. So why did money move out? Well, one theory is that perhaps if there are going to be rate cuts, you want to move to risk. And that's what was drawing in that flood of money into the Russell 2000 away from the Magnificent Seven. So that's telling you about the kind of shifts that we're seeing on Wall Street. By the way, a lot of big bank earnings, including Wells Fargo, Citi, JP Morgan, all of them are reporting today. So it's pretty hectic out there. But coming back to our earnings here now, why am I saying that TCS is perhaps more than just a small, uptick in terms of the estimates? It is a beat on the top line. It is a beat on the margin front and the commentary. I just want to put up one quote from the TCS CEO, Krithivasan. He says it's a strong start to the new fiscal with all-round growth across industries and markets. Almost all their verticals are back to firing. And when we hear more from them, Rima and Prashant, of course, in conversation with the management, will understand whether it's broader than just BFSI, which are the geographies, because TCS is saying everything is firing once again on a sequential basis. And that's the kind of commentary we're hearing from the brokerage notes as well. All of them are acknowledging that it's a beat, but how big is the commentary? Is the worst really over? And that could really light up a spark on the tech space. So that's one. The last cue, and definitely not the least, is the RBI governor's exclusive, big exclusive conversation with us. The interview you heard right here on CNBC-TV18. Now, the market cue there is actually, maybe you can say, mildly negative. Because he's not indicating that there are any rate cuts happening. The Fed might be looking at a rate cut soon, but in India, he's dashing all those hopes because he's saying that inflation hasn't sustainably moved to the RBI's target of 4%. We're still in the 5% zone. So he's saying, and growth is still holding up quite well. So he's saying it's too early to talk about interest rate cuts. You'll hear more of those sound bites as the day progresses as well. But yeah, we shouldn't get too excited, Nigel, because that's a short point when it comes to those rate cut, hopes, or even a change in stance expectations. He's pretty much in that conversation, Lata, saying that, hey, listen, I don't think it's happening right now.
Okay.
But his comment was very important and very interesting. He said, but look, I don't want the markets to second guess. I don't want anybody boarding the wrong train in the wrong direction. So I'm not going to comment anymore on this.
Indeed. All right. Well, we'll get more about that conversation in just a bit. For the time being, let's run you through the equity call of the day. Chris Ward of Jefferies says that on the face of it, last Friday's US payroll data was not that dramatic, but it led to a moderate pickup in Federal Reserve easing expectations, which were further increased by yesterday's lower than expected CPI inflation data. He says that the Fed funds futures are now expecting a 60 basis of rate cuts by the end of 2024, up from 47 bips last Thursday. He says that the market is also now assuming that the first rate cut in September, he says, greed and fear would agree that this is now the base case, though clearly there are 2 more months of employment and inflation-related data before that meeting.
All right. Well, that's Chris Wood of Jefferies. Let's get you some money market views as well. Lakshmanan V of Federal Bank says the dollar index and US bond yields declined due to 3-year plus low inflation data, raising expectations of a September rate cut by the US Federal Reserve. He says Fed Chair Powell also noted a cooling jobs market and moderation in the US economy during his testimony. He says among G7 currencies, the Japanese yen saw a strong recovery as the dollar declined. Meanwhile, he's adding that Indian rupee weakened slightly due to increased demand from state-run banks and importers. For the coming session, he's expecting the USD-INR pair to trade in a range of 83.30 to 83.70.
Okay, and on the bonds front, Lakshmanan says that the US Treasury is eased in the absence of any negative surprises from the Fed chair. Jerome Powell's commentary. He adds that the US June CPI came lower than expected at around 3% and increased the odds of an earlier rate cut by the US Fed. He adds that the coming sessions could see the 10-year benchmark bond yield trade in the range of around 6.95 to 7.05%.
Well, we have a lot of stock-specific action to track today as well, and we'll get to it in just a bit in our top 10 segment. We're looking at, of course, TCS, Interglobe Aviation, Anand Rathi, LT Foods, Brigade Enterprises, Adani, Wilmar, Infosys, and Affle India. That are all the stocks on the back of positive news flow. Prestige Estates, Vodafone Idea perhaps could open in the red, and we'll tell you why in just a bit. Okay, and we finally have our Three Musketeers team because Sonia has also made it to the studios. Quite a morning, Sonia, right?
I think both of us were wading through the same traffic, right?
And
wondering the traffic, the water, all the water logging. But yeah, I mean, it was hard this morning. And I think there's an orange alert issued right now. It's low tide. So high tide is, I think, at 4 p.m. in the evening. So by then,
bang on when we're leaving for home.
So, whoever's not left for home, don't leave. I mean, enjoy your chai or
wherever you
at home.
Whether it's office, whether it's home, whether it's wherever, just stay where you are for the next couple of hours.
Just stay put where you are, yeah.
Absolutely. Okay, well, let's get back to the market. We're all talking about the inflation print in the US, which led to that massive move in bond yields on the way down and a huge rotation, very interesting rotation in the nature of stocks as well. James Knightley, Chief International Investment Officer at ING is with us now. James, thank you so much for joining in. We're sorry, just went off topic. We're discussing the huge Mumbai rains, big monsoon rains this morning here. But let's get back to the big story, which is, after the jobs report, now we have the consumer inflation print in the US and everyone's saying we're getting a Fed rate cut. But I want to start with what you thought of the way the equity market is, interpreting this. Is it really, back to risk in a big way?
I'm a little bit cautious. The Fed are cutting for a reason, and that's because the economy is cooling and inflation is also cooling. So I do have a fear that we will see corporate earnings coming under a little bit more pressure. I think for now, there's just a little bit of optimism that, yes, we're finally going to get the interest rate cut. This could help cement this expectations of a soft landing. And as a result, we're seeing a bit of money flowing out of the tech sector into the broader economic sectors of the market. The divergence between tech and everything else has been so vast. From a valuations perspective, it may well make sense just to do a little bit of rotation, but medium to longer term, as I say, the Fed are going to be cutting interest rates for a reason, and that is because the economy is weakening. And as the economy is weakening, corporate profits are going to be weakening as well. And that may make further gains in equity markets later in this year more hard to come by.
That's interesting you say that, and it's good to remember academics 101, right? That's the way logically it should work. But the market gets excited at the prospects of a rate cut because then, cost of money will go down. And we saw that play out in the bond market yesterday as well. So just on bonds, what's your expectation? How much has the market priced in? I mean, are these cuts already priced in at about 4.22 on the 10-year? Or are you expecting a further drop in yields that could, for the time being, at least power the equity market as well?
Yeah, I mean, we think, we've been looking for three things for quite some time for the Fed to become comfortable about cutting interest rates. One is, of course, a series of 0.2 month-on-month or below inflation prints, and we're seemingly getting those now. We've got a really good one today. Secondly, we're looking for the unemployment rate, which has gone from 3.4% up to 4.1%, perhaps rise a little bit further, say 4.3, 4.4. And I think that is the pathway that we're on. And then thirdly, we're looking for the consumer sector in the US, which of course has been that huge engine of growth, to start cooling. And remember that growth was coming in at an annualized 3.5% consumer spending growth in real terms throughout the second half of last year. through the first half of this year, we're coming in at 1.6, so it's more than halved. And that cooling of the consumer, coupled with lower inflation, coupled with rising unemployment, as I say, is why the Fed can start to become more comfortable with the idea of rate cuts. And we think they're not going to just stop at one. We think there's going to be a whole series of rate cuts. So yes, I do think Treasury yields are going to fall further. I think we'll probably break below 4% in the next few months as well, once those rate cuts really start to come through and the market really starts to have something to really play with. And I think, in the initial phase, equity markets may like that. But as again, we come back to the point, if the Fed are having to cut rates more aggressively because of a cooling economy, that's going to feed back into corporate earnings. And I think that's going to be the dominant story as we move into the latter part of this year and into the early part of next year.
Okay, so you're expecting a whole series of rate cuts by the Fed. That's interesting. James, thanks a lot for joining in. How are you feeling about emerging markets like India? Because this has been a great space, record highs. We have a big union budget upon us. Earnings have been picking up even in beaten down spaces like technology, for example. Is this a market that will continue to be top of mind, top of the pecking order of global investors?
Yeah, I mean, the economy is still performing pretty well. And as you say, your interview with the RBI governor, suggesting that there's there's little imminent chance of another rate cut or a rate cut starting. So the economy is looking pretty solid. And I would have to say, that the world is kind of split in three different peer groups right now. You've got those that have already started to cut rates, such as Latin America, Eastern Europe. It's now been followed by the European Central Bank and the Bank of Canada as well. There's a group that we think that are going to be on the cusp of cutting, the Fed, the Bank of England. And then there's those that there's very little prospect of any cuts and possibly even rate hikes. Japan, Australia in there. And I think India can be put somewhere between that second group and the third group. But, there are certainly still parts of the world that are firing on all cylinders and doing very well. So we've got this sort of diverging story. And I think that's going to be very interesting, currency markets and rate markets as well.
All right. Hi, James. Good morning and good to see you in. What about, in terms of emerging markets? You were a little bit cautious on the Chinese markets the last time we chatted. What about this toss-up between India as well as China? Because we've got plenty going for us, but valuation-wise, we're not very, very cheap. Though we have earnings growth, and that's something that you've been focusing on. While China, valuation-wise, is attractive, but there are various sore points in the economy and earnings as well not really showing up.
Yeah, we've been a little bit wary on China for quite some time, and I think one of those key threats is, of course, US election risk as well. We've had Donald Trump, who's doing very well in the polls in the wake of Joe Biden's disappointing, shall we say, performance at the recent debates. He's coming under real pressure there, and Donald Trump does look as though the expectation of a Trump victory is rising. And if that is the case, what are some of his key proposals? Well, a key one is that he's going to slap tariffs of 60% on all products coming from China into the US economy and looking to ban within 4 years the import of Chinese pharmaceuticals, electronics and other goods as well. Other countries are not going to get as much of a battering, shall we say. Most other countries are facing a 10% tariff under a Trump regime. So, there's a little bit of caution about that China story, not just domestically, but also politically on the global stage as well.
Okay, James, thank you for joining us and, appreciate your time here and your comments on CNBC TV18. That's the Chief International Economist at ING talking about a series of rate cuts that he's expecting from the Fed over the next many weeks and months. And he's seeing money flow out of the tech sector and into other sectors. But for our own markets, the tech sector will be top of mind after a good set of numbers that came in from TCS and the fact that, sentiment is expected to pick up post those numbers. So more on that coming up on the other side of the break. Stay tuned. Welcome back to Bazaar Morning Call. So the market has been very firm at that 24,300 on the Nifty. But this morning, of course, TCS will be top of mind considering the good set of numbers that came in. And that could aid sentiment further today, both on the top line, on margins. It has beaten estimates. And commentary from the management also continues to be quite good. Brokerages have also raised their, target price on the stock. So Rima's here to give us the fine print on and also the read-through for other, IT companies. Rima, good morning.
Hi, good morning. So TCS has reported a revenue and a margin beat. The company's top-line growth has come in better than street expectations at 2.2% on a quarter-on-quarter basis. Margins have contracted because of a wage hike, but the margin contraction at 130 basis points was again a little better than what the street was fearing. The company in the press conference has reiterated that FY25 will be better than FY24, though they're saying it's too early to call out whether this kind of growth momentum is sustainable. But just as a cue for how the sector might react today, Infosys ADR was up 2.8% yesterday. Now, Goldman Sachs in a note says that the Q1 reinforces that revenue has bottomed out and should continue to improve over the next 12 months. Jefferies today has upgraded TCS to a buy. Citi, though, has a sell call, and they're saying that the growth was driven by BSNL deal. If you strip that out, X of India, which is largely the BSNL deal, not only, but largely the BSNL deal, growth was just 1.1% on a quarter-on-quarter basis. So they've got a sell call on TCS.
Okay, all right, Rima, thanks for that. In fact, we'll have the management who will be joining us on the show in a short while from now. But let's turn attention to Prestige Estates. Sonal joins us to fill us in on the update that they put out. Hey, Sonal, morning.
Good morning, Nigel. Well, for Prestige Estates, it's a dip that we've seen on a YY basis. This is at the same time when the peers have seen a YY increase but a sequential decline. So their pre-sales are down 22% on a YY basis. Volumes are down 25% on a YY basis. Average realization for apartments, villas and commercial spaces is up 16% on a YY basis. However, for plots, it's up around 46%. They also say collections have gone up by 6% on a YY basis to come in at 2,916 crore rupees. They call this dip a reason because of elections where approvals were delayed, but that is not something that the other companies have spoken about. But they say they have still crossed the 3,000 crore quarterly mark. They are very positive on demand prospects as well. So on the back of this stock will be in focus today.
Okay, thanks a lot for that. Another good quarter coming through for Anand Rathi this morning. So that's going to be a stock in focus. Vamakshi has all the details for us. Vamakshi, good morning.
Well, good morning, Sonia. Yes, it's a good quarter coming in from Anand Rathi. Let's first look at the AUM growth. AUM, which is a key indicator of the company's financial performance, saw an uptick of almost 16% sequentially. It came in at 69,000 odd crores. Now, keep in mind that the company had guided for FY25 AUM to be around 72,000 crores. So, therefore, they managed to achieve nearly 96% of their FY25 in AUM guidance in the first quarter itself. So, that bodes well for the stock. But apart from that, this growth in AUM is being supported by net inflows. They've managed to grow by almost 90% sequentially. Equity MF net inflows especially have seen an uptick of almost 170% on a sequential basis. Resultantly, we've seen good revenue come in for the company. It was up nearly 29% at 238 crores. PBT came in at 99 crores, which is an uptick of 25% sequentially, and net profit came in at 73 crores, which is an uptick of 29%. Keep in mind that the company had guided for 40% plus PBT margin and 30% plus PAT margin, and the company has comfortably maintained that guidance. They've also seen an improvement in the operational metrics, so that bodes well for the counter as well. So overall, going with the green for Anand Rathi on the back of strong numbers.
Okay, all right. Thanks a lot for that, Vamakshi. Well, let's go back to Sonal. She is here to tell us about a few more stocks that she's tracking. Sonal.
Well, some interesting news updates. For LT Foods, they're expanding their presence in the United Kingdom to tap the £1 billion pound rice market there. They have inaugurated a facility in one of the cities and they are eyeing revenues to the tune of £100 million in the next 5 years. They've already made an investment of around £7 million in the new facility, and they have a commitment of further investing up to £50 million in that particular facility. For Brigade, they have announced the launch of the latest residential tower, which is Cobalt. The overall project is just not a residential project. It will have entertainment park, there'll be shopping, wellness, other facilities as well. It is over a 6.1 million square feet area. The total revenue potential here is 400 crore rupees. For Adani Wilmar, they've made an acquisition in the specialty chemical space. They have acquired 67% stake in Omkar Chemical Industries Private Limited, which is in the business of manufacturing, buying, selling chemical and chemical compounds. The enterprise value here is 56 crore rupees, and the revenue of Omkar Chemicals as on FY24 was at 14 crore rupees.
Okay, Sonal, thanks a lot for that. Well, let's go across to Rima now to talk about some other stocks that are in the news this morning. Rima, over to you.
Hi, so let me start with Infosys. The company has won a contract from the Delaware Department where they will modernize their labor systems and replace all the outdated. So it's a contract win. Size of the deal is not known. For Vodafone Idea, the latest is that they have received a communication from one of their vendors, ATC, that's American Tower Company, that they plan to convert the balance 1,600 OCDs, optionally convertible debentures, into equity. Now, they had converted 90% of it. Only this balance 1,600 OCDs were left, which now ATC is looking to convert. And the total amount is just 160 crore rupees. So not very significant. Back to you.
Okay, all right, Rima, thanks for that. Sonia, coming back to you with regard to a couple of stocks that are tracking, Indigo.
Yes, Indigo and SpiceJet. So both of them are in focus this morning. Now, reports indicate that Boeing has notified the 737 MAX customers of further delays. So there will be further delays in delivery of the Boeing aircrafts. The deliveries could slip by about 3 to 6 months, according to reports. And some 2025 deliveries have been pushed to even 2026. Now, delays are because of many reasons. One of them is delayed shipments and, the market turmoil, the worker turnover. There's been large amount of attrition in the aviation sector as well. So all of this has resulted in the delays of the Boeing 737 deliveries. Now, who are the customers of Boeing? There's Air India, Akasa Air, SpiceJet and Vistara. So it's definitely going to impact them. And from the website, from Boeing's website, we have, more details coming through that Air India is looking to add 50 737 MAXs. Akasa Air placed an order of 226 MAX airplanes. SpiceJet placed an order for 155 new airplanes. So all of these delays will definitely have a perhaps positive impact on Indigo. So, just keep an eye out on the dynamics that are, playing in this particular sector. But here's a quick recap of our top stocks with positive news flow. There's TCS, Interglobe Aviation, Anand Rathi, LT Foods, Brigade Enterprises, Adani Wilmar, Infosys and Affle India. While stocks with negative news flow, Prestige Estates and Vodafone Idea. But there's also lots happening in the world of commodities. So Manisha Gupta joins in for a roundup of all the commodity action overnight. Manisha, good morning.
Thank you for that, Sonia. Well, yes, it was all about the U.S. inflation data that came in yesterday, which has cooled on for a third straight month in the month of June to 3%. And that has led to a decline in dollar index, in treasury yields as well. And that has led the U.S. Fed rate cut possibility to almost 90% for the month of September. That has supported many of these commodities. So you have the crude oil prices, which has seen a percentage point of gain overnight. Also, there is strong demand coming in from U.S., whether it's the gasoline demand, which is at 2021 highs, or the U.S. jet fuel demand, which is at a Jan 2020 high. Everything really seems to be supporting the energy markets right now. It's good going for the precious metals as well with the expectation of rate cut. You have the gold prices now inching very close to its all-time highs. The silver prices gained up by a percentage point as well. And the base metal prices are trading 0.5 to 1% higher at this point in time. The markets also seem to be reacting to the Chinese trade data. So it is a good start to an Asian market for commodities and a good end as well on a weekly basis.
Okay, thanks a lot for that, Manisha. Well, moving on, the city of Mumbai has woken up to heavy rains this morning, and the IMD has now issued an orange alert forecasting heavy to very heavy rainfall in the city today and on Saturday. So the streets in the city are already seeing a lot of waterlogging. There's a lot of flooding in several parts of the suburb area. But public transports as of now seems to be working smoothly, with the bus service provider BEST claiming that there's no route diversion so far, and both the Central and Western Railways claiming that trains are running normally. We will keep getting you updates through the course of the day. Okay, stay safe, guys, and stay home as much as you can, because the situation is worsening as we speak, especially with the rainfall in the suburbs area. Let's take a short break. On the other side, Siddharth Khemka of Motilal Oswal Financial will be joining in for some fundamental stock analysis. Stay tuned.
Welcome back. Here with us on Bazaar Morning Call. Now, we were telling you about this big CNBC TV18 exclusive. RBI Governor Shaktikanta Das sat down with Lata Venkatesh for an extensive interview. Here are the top highlights from the governor. Pouring cold water on any rate cut hopes. Governor Das said that it is too premature to talk about it. He also tempered hopes of a change in the monetary policy stance. The governor asserted that inflation remains above 5%, which is still a long way from the RBI's target of 4%. He also cited the uncertain global environment. Listen in.
The overall economic environment globally, not just in India, globally and in India, it is so uncertain to talk in terms of interest rate cut that I will do it, 1 quarter away or 2 quarters away. You say something and then you have to sort of take back whatever you have said today. So basically it is the uncertainty which is the one aspect. Second thing is the CPI headline inflation continues to be close to 5%. In fact, as I said, according to the surveys done, it's likely to be again expected to be close to 5%. So therefore, from that context, I think it is too early to talk about interest rate cuts. And I would rather not give, any kind of forward guidance, which may, I said it, I think, somewhere else. I would not like to give any kind of forward guidance which would lead the market players and the stakeholders and others to board the wrong train.
Okay. Would you say the economy is growing faster than potential, or is it growing at potential at this point in time?
Urban demand is holding stable. Rural demand is picking up and is likely to improve. The third component on the demand side, as you would know, is the net exports. Our exports have picked up.
Yes.
Services exports are very strong. So if you put all these things together, I think what we are looking at is that India is on a trajectory of, higher growth. And I said it elsewhere that I think there is a structural momentum to our growth drivers, and we are moving towards 8% growth. What I have said is that we are moving towards that.
Yeah.
So therefore, I am quite sanguine about India's growth. Coming specifically to the potential growth rate, on potential growth rate, I would like to say it is the direction of growth, which is important, not the exact number, whether it is 7.2 or 7.5 or 7.7.
All through the day, we'll get you interesting snippets from that chat with the RBI governor. For the time being, let's get stock specific then. And we have Siddharth Kemka, the head retail research at Motilal Oswal Financial Services, who joins us on the show. Hi, Sid. Morning and good to see you. Ben, top stock to focus on, TCS. The numbers look better than expected, both on the revenue as well as margins. On the flip side, though, some would argue that the TCV isn't as much as expected. But even though we go on saying that TCS is not particularly cheap, but the valuation gap between TCS and some of those tier 1 companies have actually narrowed. And that could call for a re-rating in their multiple even from here. Your view on the stock?
Yeah, very good morning, Nigel. Glad to be on the show early morning. So if you look at, there are two parts to the earnings, clearly above expectations in terms of revenue growth, largely led by India. And again, in that particularly the BSNL project ramp up that has helped the company gain the kind of growth they have been able to show. In terms of deal wins, I would say that there is a high base. We had seen a very strong order inflows in some of the previous quarters, and because of which we are seeing a sequential dip. But I would say it is still within its usual range. So $8.3 billion of deal wins is within their usual range. Nothing I would to be worried about in that sense. Margins have been better than expectations. I think overall read through from the TCS results and the commentary comes out clearly very positive for the entire IT space. Things will take time to improve. There is definitely a slowdown, and you can say the spending environment is yet to revive, but things have stabilized. And from here on, I think FY25 will be a stable year, and FY26 will see the recovery. So for FY25, we are building in a 5.5% of constant currency revenue growth for TCS, which is a good, decent growth on FY24. And for FY26, we are building in a recovery and building in around 8% of growth. With the largest order book and the most diversified, long-dated projects, I think TCS is well suited to face the current slowdown that we are witnessing in the entire IT spending. And while the valuations, I think some of the other top tier IT have narrowed down, we believe that TCS premium valuation would continue. So we continue to value it at 30 times on a forward earnings, and maintain its buy and as a preferred pick within the IT space with a target of 4,660.
4,660. That's still a fair amount of headroom from where we are. Siddharth, hi, morning. What about the others? I mean, because they're saying that growth has returned to all markets, almost all verticals, I think the street will want to believe that this signals the end of the dark winter for the entire sector. Beyond TCS, would you load up on any of the other IT names? And just in terms of the portfolio construct, what percentage would you give to IT, and how much would that change based on what TCS has said now?
Yeah, definitely should be. So if you look at, as I said, the read-through from the TCS numbers and commentary makes us positive on the entire IT space. So from a portfolio construct perspective, we are now marginally overweight on IT compared to our underweight stance earlier. So some of the other IT companies that we like, so HCL Tech is our preferred pick. We believe that it's the portfolio is much more tuned and relatively more resilient to the adverse macro environment. Its exposure to cloud, which compromises a higher share of the non-discretionary spending, offers a better resilience in its portfolio in the current context. And the overall growth as well as valuation is pretty comforting there. The other stock that we like is Infosys, again, among the larger peers. So these are the three stocks that we like: HCL Tech, TCS, and Infosys within the IT pack.
Okay, well, stay on, Siddharth. I wanted your thoughts on Protean e-governance. If you track that, company, that's actually on our radar, Protean eGov Technologies, and it's had actually a very good run in the last 1 month. It's up about 35% odd. To discuss how the business momentum is, what is the growth outlook. Remember, Protean eGov deals with a lot of ministries. They are an IT-enabled solutions company, so they provide a lot of e-governance solutions for the Ministry of Finance, Commerce, Education, etc. So the outlook and the scope is pretty good. Suresh Sethi, Managing Director and Chief Executive Officer of the company, joins us now to talk about that. Suresh, hi, good morning, and thank you for taking the time out early this morning. Your FY24, the previous year, right, revenue growth was quite strong. Almost a 20% growth is what you're looking at. And that was largely because of the PAN card issuances that you've been doing, across other verticals as well. But just trying to understand, going forward in FY25 and 26, what kind of growth are you looking at, and where do you see maximum traction now coming from?
Yeah, good morning. So I think primarily, if I look at all the sectors, our growth story is primarily linked to the India story on digitization and financialization. The clear headroom comes from the fact today, as we look around with the digital public infrastructure, whether be it identity, which is Aadhaar, which is today used for opening bank accounts, for enabling transactions. Similarly, looking at the payments architecture on UPI, or even the new age digital, data exchange. In all these cases, there is going to be a dominant use of any sort of identity, whether it is Aadhaar, whether it is PAN. And that is where we are seeing the growth coming in, because in all these sectors, there's huge upside. First of all, we are looking at accounts getting opened digitally, financial transactions happening in a digital mode. And whether it is investments, we looked at mutual funds and corporate market investments. And each of these transactions today requires some usage of identity in a digital mode. And that is giving a huge upside to all these businesses. And that is where we are seeing the growth coming in.
Okay. Any other new opportunities that are emerging for you? Because, there are reports that you're entering into an agreement with the Election Commission for data maintenance. Given that a lot of these things are center stage now for the government, now that the government has come back into power for the third term, do you see a lot more opportunities on this front?
Yeah, absolutely. Because if we look at our growth on the digital public infrastructure, it is primarily now straddling across multiple sectors. So it is not just looking at financial services and inclusion. We are clearly seeing use cases happening in digital commerce and open finance fueled by ONDC, another area where we continue to contribute in enabling that entire ecosystem on digital commerce. We are looking at transport and mobility, agriculture, health. So all these areas are giving multiple opportunities. And ultimately, a lot of it is related to data exchange, to exchange of data in a very consent-driven manner, because the owner of the data should have the ability to control where the data is shared and where the data is used. And that is, I think, what is going to be critical growth area for us going forward and even as we speak.
Okay. Mr. Sethi, then let's talk about, the opportunity also in terms of numbers. When I know you can't get too specific till we are over the quarterly report. But in general, I mean, the market has been wondering what sort of more consistent and let's say 2-year, 3-year CAGR can they look forward to in terms of top line and also margins, because your margins had come down quite a bit. I think FY24 at the EBITDA level from levels of 15-16%, they came down to 10%. So why so much of volatility? And I'm not, asking for a 1 quarter, 2 quarter kind of an outlook. Just trying to understand, as you're scaling up on all these fronts, what should your stakeholders expect in terms of top line and margin profile for the company?
Let me give a little bit of reflection into the profile of the businesses we are running. So we have 3 traditional strong businesses where we have been contributing in these, I would say, foundational ecosystems right from the outset. Whether it is taxation, whether it is pension or identity at a foundational level. These continue to be naturally our growth, engines for the company and stable business drivers. And we've seen consistent growth on these businesses. And even last year, these grew at a very healthy pace with all the sectors that we spoke about earlier. And we continue to see them being stable and growth areas. Our new areas of business where we are getting which are the really big, growth enablers for us. It is the new age DPIs. It is building on top of the ID foundational stack and looking at building a complete data stack for digital onboarding and lending. And also the infra services that we provide on cloud and InfoSec consulting. So these new areas will again give us a uplift in terms of CAGR because these are value-added businesses. And otherwise, we see this going stable. But to address the point of the margin coming down, so there has been significant investment by the company over the last couple of years in people and technology. We've in-housed a lot of centers of excellence on new and emerging technologies, especially to fuel our contribution in the new age digital ecosystems. And that is what has shown a jump year on year. But we look at that becoming now a more normal growth going forward because a lot of investment has happened. And we have a host of new products that we've launched during the course of last year, be it Protean Rise, be it eSign Pro, be it CYC. And that is where we are seeing which will be the growth drivers for us going forward.
So what's the aspirational number? I mean, if I could even get a range, say 15-16%, is that a steady expectation to have in terms of margin profile? What happens is one thing, but there would be an aspirational target that you've set forth for the business.
Definitely, I would sort of indicate that would be aspirational because existing businesses have a historic, trajectory where we have shown a growth of 10 to 12% because these are our stable businesses. New businesses is where we see the uplift. So as you said, we would definitely aspire to have better growth going forward.
All right, very quickly, sir, Protean is a founding member shareholder of ONDC that you briefly spoke about. Now, reports indicate that ONDC is looking at monetization. What could it mean for Protean in terms of revenues? Queris, they put out a note. They've done a sensitivity analysis, and they are looking at an opportunity of closer to 95 crores for FY26. You agree?
So there are 2 parts to it. If you look at a foundational level, we power the ecosystems by providing the network technology, which is the gateway and the registry. So every transaction running on ONDC is powered by our technology today. And today, largely, we are getting covered or reimbursed for that technology contribution by ONDC. But down the line, we clearly see as the market opens up, as there's more adoption, this will become a market play. So that could be technically working towards an inflection point where there's significant growth and therefore adoption. And we look at something coming out of that at that stage.
Okay, thank you for joining in and speaking to us about the business. That's Protean eGov with their fundraising plans and the business as well. Overall, we have 10 minutes more for the pre-opening rates to kick in. Mitesh Thakkar and Shrikant Chauhan will join in for some technical trades in just a bit. Stay tuned.
Welcome back. You're with us on Bazaar Morning Call, and it's time to get a technical check on the market going. Of course, we have our experts joining in on this rained-out Friday morning. We've got, of course, Mitesh as well as Shrikant. Gentlemen, hope you've got this warm cup of tea, coffee, or whatever is your drink to power you up. Let's quickly get down to then the ideas for today. Mitesh, consolidation yesterday. How would you look at the Nifty and the Bank Nifty today?
Good morning, Survi. No, I've been calling for consolidation. The last time I called for it, it lasted for about 2-3 days, and then there was a very strong up move which happened immediately. So difficult to say, how it will go. But yes, I think, with the gap up opening, the GIFT Nifty is indicating we'll open around the previous highs. And typically, I think, that could lead to some kind of movement on the upside if things go well. So the way to approach is if we see 24,420, 24,450, which is the earlier highs being taken out, then I think, you look at adding onto your long positions. Though with stock-specific biases, we've been trading with long bias, but I think, the fresh position should be taken once we get past the earlier highs of 24,420, 450 levels.
Okay, Shrikant Chauhan is also with us. Shrikant, a strong start is expected today in the market. And we also have good earnings from TCS to buttress, the up move. At what point do you take a fresh long position, and what are the levels to watch now?
Yeah, good morning, Sonia. Good morning, everyone. I think, yesterday only the market has given a very clear bullish reversal signal, because when it was consolidating very close to 24,200 levels, that time we saw specific buying interest in even Bank Nifty as well as few IT companies. And the base part was that the market closed above the levels of 24,300. So if any aggressive trader, then even at current level, it's a buy, because based on the technical formation, I'm of the view that the markets are now ready to move towards 24,600 levels. So 24,200 should be the final stop loss for holding any long positions. And in the near term, I think we are heading towards 24,600 based on Nifty's formation. And for the Bank Nifty, there also we saw a quick reversal despite the Bank Nifty has broken the level of 52,000, which is something positive. So based on its formation, I think Bank Nifty is also heading towards 53,000 in the near term.
Okay, all right. Hi, Shrikant. Hi, Mitesh. Good morning and good to see you all in. Since you briefly spoke about the Nifty Bank, Shrikant, I wanted to review on HDFC Bank. It went down to around 1,600 rupees, but it closed closer to its 20-day MA. So quick word on HDFC Bank, and then you could give us your picks.
Yeah, good morning, Nigel. I think it was falling vertically after hitting the levels of 1760, 1780 after specific news flow. But yesterday's formation is indicating us that the stock is again ready to rebound from current levels. I mean to say we can see the levels of at least 1670, 1680 in the near term. That's the overall view based on yesterday's formation. So 1590 should be the final stop loss for creating long positions even at current levels. And even if there is gap up opening, I think we should look for adding HDFC Bank to the trading portfolio.
Okay, let's talk about Mitesh's picks as well. Mitesh, stocks for today?
Yeah. I have all buy calls today. A buy on HPC, and yesterday the refineries did well, and they are showing now some short-term up kind of signals. So buy here with a stop at 343 for a target of 365. A buy on Balrampur Chini with a stop at 438. I would look at targets in the range of 460, 465, and a buy on LIC Housing Finance with a stop at 777 for targets of 820. And finally, ONGC, which made a fresh high, also features on the list. Keep a stop at about 298, look for targets of 315.
Okay, and Shrikant, what about you? What are the other stocks that you're looking at this morning?
I think, today we are going to see some activity. I can say the buying interest in IT companies, and in that Tech Mahindra. There we are specifically bullish because it was like consolidating, but its overall formation is suggesting us that it is heading for at least 1550 or 1575 in next few days. So it's a positional buy, but at current levels, the stop loss level is very nearby. We can keep stop loss around 1440 for the same, for creating long position on Tech Mahindra. And we also like a few metal companies in that Hindalco. That should do well. It is holding around 690, 700 levels, but it is heading for the levels of 725 based on its technical formation. So Hindalco is also a buy at current levels with a stop loss close to 690.
All right, got that. Shrikant, thanks very much. Both of you will come back a little later to get some more stock ideas going. Well, let's get you some big exclusive snippets from our latest event. Top business leaders and newsmakers gathered at the CNBC-TV18 CII Budget Town Hall to put forth their expectations from the upcoming budget. A higher capex allocation to spur consumption, incentives to boost skilled manpower. These were some of the demands put forth by industry. India Inc. also pushed for the sunset clause on the 15% concessional tax scheme for new manufacturing companies to be extended by another 5 years. Listen in to what Sanjeev Puri, President CII and also Chairman and MD of ITC, said at this big event.
Consequent to COVID, we have seen the cost table, and a lot of it because of external factors has actually gone up. And because of that, there is a challenge on consumption across the world. As far as rural is concerned, given that cost of everything has gone up, what CII is recommending is that the amounts through direct benefit transfer, the amounts through Manrega, and income tax at the lower end, below 20 lakhs, there should be some relief in, and all the other areas should be increased.
Welcome back. You're watching Open Exchange live from the CNBC-TV18 Motilal Oswal studio. We have just a couple of minutes before the pre-opening rates kick in, and it looks like it's going to be a good one this morning. Sneha Seth is joining in. She's the derivatives research analyst at Angel One. Sneha, hi, good morning. Good to see you in. It's a rainy morning here on the Lal Street, but looks like it's, raining positive news as well. We have TCS's good numbers. Overall, there was large buying by domestic institutions. Do you think we can build on to our gains? And if yes, what are the levels to look at? What are the stocks you're looking at?
Very good morning, Sonia. If we look at yesterday's session, we have seen a very strong recovery from the support zone. In case of Nifty, 24,200 was the support zone. In case of banking index, 52,000 was the support zone. So from there only we have seen a smart recovery. But today it is important that we see a follow-up buying and a sustainable close even. If we see a closing above 24,400, 500 in case of Nifty, then we may see a follow-up buying interest. In case of banking index, 52,700, 800 zone is the important level to watch out. Any move above this would be interesting to watch out. However, if we see FI's activity in index futures front, they have long-short ratio around 78 and they have been decreasing their long position recently. So any further decline in this ratio would create some, profit taking in our market. So need to keep a close watch on that. But as of now, I believe unless and until we are trading above, say, 24,200 in case of Nifty, I think the biasness remains still positive. As far as individual counters, I have two buy calls. First one is on Sun Pharma. Sun Pharma looks quite good at this point in time, and I believe we can go ahead and long with this counter with a strict stop loss of around 1548, and the target expected will be around 1659. Apart from this, Balrampur Chini looks good, so we would recommend buying this counter with a strict stop loss of 435, and the target expected will be around 464.
All right, got that. Thank you very much for all the ideas and all the trades. You have a good session. Well, we will be getting our pre-open rates in just the next couple of minutes. I mean, they've started trickling in. Let's just wait for them to stabilize. But still, for what it's worth, I'm picking up the TCS rate. Okay, so starting off with a bit of a quiet, opening. That's TCS, just about a 0.25% up on the in the pre-open session. Now, interestingly, I mean, the company also kind of talked down the enthusiasm in the conversation that happened just in the press conference yesterday, because I mean, the numbers are obviously ahead of expectations. All their verticals are firing. Most geographies have come back to growth. But the company has also said that it's tough to say right now whether this momentum can be sustained. So kind of, putting a bit of a caveat over there. We'll discuss this with, an IT sector expert as well in just a bit. Siddharth Khemka is still with us. Siddharth, what else? I mean, we've discussed technology. Let's talk about the market's Achilles heel as well. HDFC Bank. I mean, would you still retain a positive view? Or is it just best to look elsewhere within banking? I mean, from a more short to medium term horizon.
Yeah, Surbi, I think from a short-term perspective, one definitely needs to look way beyond HDFC Bank. They have come out with the quarterly updates. So the street was excited earlier after the shareholding pattern came in and with the expectation of some MSCI inflows. But the business continues to remain a bit sluggish, especially on the deposits front. For the first time, they have also come out with the average deposit growth rate, which is still better rather than the quarter-end deposit numbers. But I would say there are banks which are doing comparatively better. So we like the public sector banks, especially SBI, which has been consistently doing well. And within the private space, ICICI and Axis would be our preferred picks for the short term.
Okay, thanks a lot for that, Siddharth. We have the pre-opening rates we're kicking in. As Surbi was saying, TCS will definitely be in focus, reported a good set of Q1 earnings. HCL Tech will be reporting the earnings today. So discuss in detail how Q1 will pan out for the sector. Omkar Tangsale, the senior research analyst at Axis Securities, joins us now. Omkar, thanks a lot for joining in. Good morning. Good numbers coming in from TCS. The management also saying they're maintaining that FY25 will be better than FY24. But your sense on which way the stock could head now, and have you changed your earnings estimates? Because although the numbers are not bad, the deal wins are on the subdued side. So how would you read into that?
See, I believe it's more of, the deal ramp up and increased client engagement rather than deal wins, because they already have ample of deals on their the deal pipeline is still very resilient on their balance sheet. But I believe more of, increased client engagement. And now for this quarter, around 1% growth has came from India business. So that is the kind of things. But I believe it's more of, increasing client engagement that one should be considered it. And the management are also highlighted that if the outlook hasn't changed a bit then likely to remain for a couple of quarters, but they have seen some green shoots in BFSI verticals, in small pockets and manufacturing and the healthcare part. Yes, telecom will likely to be subdued, but likely to compensate with the other verticals as well. So I believe it's more of, on a longer run horizon, the demand scenario is smallly picking up. Now the US elections are still there, so uncertainty will likely to remain in some parts. But I believe it's more of a resilience and changing up and shaping up of the demand going ahead.
Hi, Omkar. Good morning and good to see you, Ben. TCS used to trade at a valuation premium in comparison to its peer group. And that's narrowed quite a bit. I think now you have Infosys, HCL Tech as well. They've narrowed it quite considerably. Given that in terms of return ratios and probably growth, TCS could still be an outperformer. Do you think it should get back its premium in comparison to its peers?
I mean, definitely, if there will be, the TCS has always been an execution masters, and TCS as grows in the volume, they are giving the strong margin profile, strong return on equities, which will be very lucrative to their investors. And they are also a dividend paying company. So they are ticking up all the criteria that for the investment horizon. So if I would like to, specify in a valuation terms, the TCS will likely to gain as, we can going up near to the recovery side. And in terms of demand, I'm saying, and we can see some premiumization of, in terms of valuation going ahead, but not at this moment of time when there is a huge uncertainty. I mean, there is an uncertainty is going around. So, but I believe definitely TCS will catch up a bit going ahead.
Okay, Omkar, word on HCL Tech as well, which is reporting. We're all looking at the revenue declining. The company also kind of guided for it, right? It gave a clue to this, saying that there is, I think, offshoring in a large deal, and because of that, it's going to be a volatile quarter in the BFSI vertical. Yeah, but even if we look past that, I mean, what is HCL Tech's trajectory? And from an investor perspective, are you just better off with the leaders, TCS and Infosys? Where does HCL Tech stand in your pecking order?
Yeah, I mean, definitely TCA as HCL Tech is having the better comparison. I mean, the better business metrics as compared to the other verticals, which reduce the dependency. If you have seen in the past 1 year, its year-end business have grown up as compared to the other services, and also hello, I'm audible.
Yeah, we can hear you, Onkar.
Yeah. And also on, the product and platform business has demonstrated strong growth when in the Q3, especially when the other companies are reporting sluggish growth because of the furloughs. So it's a better balance, to be very honest with you. And as compared to the traditional, in case of where telecom, BFSI and high tech verticals are tampered down, they are have the manufacturing exposure with R&D. In these verticals, the investments are happening, and from the large enterprises, the automobile OEMs are investing in auto transformational deals, apart from the cost optimization deals that the traditional IT services is being looking for. So we are more positive on HCL Tech. We are expecting the HCL Tech to retain the guidance of 3 to 5%, maybe, which will likely to outperform in their large cap Indian peers.
Okay, so you're still positive on HCL Tech. Fine. Just before we let you go, in the mid-cap IT space, what are your topics?
We are still positive, on ER&D space, and KPIT and Persistent are the two companies that we are looking for. Despite of having premium valuations, we believe that they are performing robust and consistent growth over the period of time, and KPIT is being still given the guidance of 18 to 22% with a margin growth of margin expansion of 20.5 they have guided for, and around 100 basis point of margin expansion that they are expecting during the financial year FY25. So we are bullish on KPIT, and also Persistent. Persistent also demonstrating well in terms of revenue and the margin expansion. Yes.
Okay, thanks a lot for that. Well, those are, the views on the sector as well as how to approach TCS, revenues and margins, beat estimates. A lot of brokerages actually have raised their target price. UBS has raised its target price on TCS to 4,600 rupees. So that's a big upside to the current market price. But let's get straight to all the market action now. Mitesh, what is the big call at 9:10?
Yeah. I'll go with the buy on LIC Housing Finance for targets of 820.
Okay, and Nimesh is joining in now to give us the standout brokerage report of the day. Nimesh, over to you.
Hi, morning, Sonia. So today's standouts in Oil India. Interesting report from Morgan Stanley. They've turned more bullish on the stock, and they've raised the target price now to 663 versus 496 earlier. Now, there are a couple of reasons they're turning bullish on. One, the gas production has doubled for the company in the last 4 years. The capacity of one of the most profitable refinery in Asia, that has tripled in the last 4 years. Company has a hydrogen monetization of almost 38 years, and the operating cash flow has been at a 14% CAGR in the last 4 years. Despite all this, the stock is still trading at single-digit multiple, which is at 7.5 times on FY26 estimated PE. So valuation is comfortable. Also, company has got a good track record in terms of dividend distribution, and Morgan Stanley believes that the earnings are likely to double by 2029, which the market is under appreciating. So on back of all this, a big upgrade on Oil India as far as target price is concerned. So Morgan Stanley has now raised the target price now to 663 versus 496 earlier.
Okay, all right, Nimesh, thanks a lot for that. Well, let's focus on the cement space. And Motilal Oswal, they have written an exhaustive note on the cement stocks. First up, let's tell you what their calls on stocks are. They have upgraded both ACC as well as Ambuja Cements to buy from neutral earlier. On ACC, the target price is 3,300. Ambuja is around 800 rupees. The other buy calls, they continue to reiterate their positive stance on Ultratech, Dalmia, JK Cement, JK Lakshmi Cement, as well as Birla Corp. They have a neutral rating on a couple of those large names, that's Ramco as well as Shree Cement. They're highlighting 4 big factors for the cement space on the whole. One is consolidation is likely to benefit the larger names, and that could emerge as a new theme. They say that some of these smaller entities, they could get enticed if a good offer is made to them, and that's where this consolidation theme is likely to pick up pace. Next up, in terms of clinker capacity addition, there's close to around 79 million tons of clinker capacity that will be added in the next 3 years or so. Out of that 79 million tons, close to around 72% will be added by the top 4 players itself. So that's telling you that the large are going to get larger, and when that happens, there is pricing strength that comes back as well. Point number 3, utilization levels have improved in the last few years. They've improved from an average of around 70% to around 78% in FY24. Going ahead, that's by FY27, they're seeing this 78% can further improve to around 81%. So that's why they're factoring in better demand in the coming years. And point number 4, finally, on the cost side, they're saying that the increasing green power as a percentage of the total mix, that bodes well because that will reduce costs. They're given a couple of numbers. In FY15, the total green power as a percentage of the mix was around 7%. That's increased to around 35%. And in the coming years, they expect it to go to around 50%. So they've upgraded ACC and Ambuja Cements, and they're viewing this consolidation theme that could pick up further steam going ahead.
Okay. Well, Mitesh Chakkar is still with us. So, Mitesh, I just wanted your thoughts on Reliance Industries because, next week on Friday, Reliance will come out with its numbers. So, this is a 1-week period that traders have to sort of accumulate any positions if they feel, it's valid. And considering the leadership that Reliance has had so far, maybe there could continue to be traction here. But what is your view? Is it worth taking a fresh position in Reliance now ahead of the numbers?
Typically traders would avoid the event, but Reliance chart is very good, and in fact, it's broken into fresh highs and is giving a mild pullback. From a trading point of view, I think anything around 31.30, 31.20 should call for long positions and add more around 3100 levels. Keep us 30-point stop loss below that from those levels. So I think around those levels you will see good support and possibly a continuation of the upside.
Okay, I think we just have a couple of minutes to go. And the pre-open is telling us that we'll have a steady start, about 70 on the higher side, with, of course, some of the IT names adding to the sentiment. LTI, Mindtree, Wipro, Infosys, TCS, HCL Tech. It's all IT really on the upside. The key is going to be banks once again. Will banks start pulling things down as has been the trend? Yesterday also we saw that weakness in the first half at least. So that's something we have to watch out for. By the way, keep looking at auto stocks. I think today we're also awaiting more clarity on this whole UP business, right? Yeah. In terms of electric vehicles. So let's see how that goes. But the first rates are in and it is off to the races for the IT sector. TCS 2.5% up. The market giving it a big thumbs up on the beat that's come in. All of its peers, Wipro, LTI, Mindtree, Infosys, Tech Mahindra, even HCL Tech, which is expected to show a drop in revenue today sequentially. Even that stock's up about 1%. So IT is very strong. Some of the PSUs are starting off positive. Coal India, BPCL and ONGC are continuing the good work from yesterday. There's some buying on L&T. So this is where the top side of the screen is. And the start isn't in line with what the pre-open was telling us, about 70 points higher.
Absolutely, and building on to our gains, right? Building on to the gains that we've seen for the last many days. So apart from TCS, there's LTI, Mindtree, Wipro, Infosys, as you pointed out. Also, let's look at Reliance Industries because it comes out with numbers, next week on Friday. So Reliance ahead of that is up in the green. In the ACC Ambuja also in focus, so keep that on your radar. But in the broader markets, plenty of stocks actually. There's SCI, SR Shipping, RCF, SJVN, Oil India, Nimesh was talking about that, 3% higher on Oil India. Z Media up almost about 2%. You have Geo Financial Services in the green. Federal Bank, NMDC Steel, Z Entertainment, there's a board meeting coming up. IRDA, Hoodco, NHPC, all trending in the green right now. But really the stock of the moment is TCS. It's providing the support for the market this morning and making sure that the Nifty cruises past the 24,300 mark. So looking pretty good, but gaining a little bit of ground. And a couple of other frontliners that do deserve mention this morning. L&T is one of them, up about 0.5% and gaining some ground. Titan, Bajaj Auto, ONGC are a couple of other stocks. What's dragging this morning is Maruti, down about 1.5%. M&M has been in the red for the last couple of days, so let's see whether there's any traction over there. HDFC Life, Apollo Hospitals, HDFC Bank are a couple of other stocks. They're slightly muted, you'd have to say, but otherwise it's a really good start to trade.
Well, that's right. TCS has opened up in the green, and just take a look at what the mid-cap IT is doing. Emphasis up 5.5%. Coforge up close to around 3%. Persistem up close to 2%. So mid-cap IT, they're reading this as a positive going ahead. Overnight we got some hopes of rate cuts from the Fed, and also you have TCS's numbers, and mid-cap IT actually is the big mover today. Oil India, as Nimesh mentioned, that was the brokerage call of the day. Yesterday, the stock ended at the high point of the day. Actually, it saw big buying in the last 2 days. The delivery as well is massive out there. And today, it's building on to those gains as well. So that stock is up and about. A couple of stocks that are lower. IOC is down close to around 4% as we speak. So that's coming for some selling pressure. ABP India, I think there was a cautious brokerage note that came in overnight. So that's pulled back as well. But keep in mind, that's been one of the big winners. From the broader markets, HPL Electric, they won a big order. Yesterday, the stock was flying away. Today, it's up another 15%. And for the week, I'll tell you what, that one's up more than 40%. SEI, another stock that yesterday did very well. The street is hoping that there will be some divestment movement out there. It's up another 10%, SEI. And for the week, it's up more than 35%. Even SCI Land is up close to 6%. For the week, it's up more than 20%. So some of these stocks are moving very well. And IRDA is just moving from strength to strength. On the first day of listing, I recall the stock went to more than 100 rupees. Then it paused at around the 200 rupee odd mark. And for this month itself, IRDA has seen a big gain. IRDA is up 50% in this month. So that's the kind of move that we've seen. IRDA, pull up Hutco, that was the other one that did very well yesterday. So that stock as well, I think, was higher in pre-open. Let's see what it's doing. Hutco should come up for you on the screen, guys.
Well, some more names. Raymond, which is going through the process of that demerger of the real estate business, up about 4%. Nava up about 4%. By the way, on shipping, SCI, of course, is really taking the cake, as Nigel pointed out. Some of the other names as well, and that's why you have to be a little cautious when all kinds of shipping names, including SR Shipping, is up and about. Anything to do with shipping. Remember, our sister channel Awaz had reported that the budget could set up a shipping fund, a Harit Nauka fund, and this could have a corpus of anywhere between 15,000, 20,000 crores, and therefore more work, more orders for these companies, perhaps, and cheaper access to funds. That's the most important thing, and that's got some of them excited. Memphis is, of course, 4.5%, retaining that upside. Now, we didn't discuss what's pulling down the Nifty, because after starting 70 points higher, there's a bit of a cool-off. And what's pulling things down, one, as I mentioned, there's still some uncertainty over what is the UP government's ultimate policy with respect to any incentives for hybrids. First, they said absolutely no road tax on hybrid vehicles. Now, I think there's some rethink, and maybe they'll announce some caps or thresholds in terms of the pricing of the vehicle or the size of the vehicle. So that's leading to some correction on stocks like Maruti. There is a bit of a cool-off on some pharma names like Divi's and Sun Pharma. And of course, the biggest culprit is the Bank Nifty once again. It's not falling, the Bank Nifty, but it is that one red tinge that we've got on the screen. Those are the pharma names. Nifty Bank is down a little bit. Let me check HDFC Bank before we move on. Yeah, that is a big one, down about 0.3%. And even ICICI, this is a repeat of yesterday. These two big boys were the ones that were dragging their feet even yesterday, while the others had recovered. SBI, for instance, it's just that yesterday's trade continuing. SBI is still positive, but it is HDFC Bank and ICICI Bank that are the key watch points from a bull's perspective.
Also, a couple of stocks I wanted to mention. Zomato, by the way, I know we've talked about that ad nauseum, but it's at a fresh high today. And it's had a phenomenal year, right? I mean, we're just not even into 7 months of the year. And Zomato is now up almost 76%. So big moves coming in there. Fresh high on Zomato. IRDA is the other one, a darling of the market. Fresh high on IRDA this morning. Almost at 300 rupees now. Huge 200% gain this year on IRDA. And the market cap of IRDA now is almost 80,000 crores. So these are two stocks that I just wanted to mention, Zomato and IRDA, picking up a lot of pace this morning.
Absolutely. I mean, there's been just absolutely no stopping these PSUs. In fact, let's discuss this and a lot more with our next guest on the show. Our market master of the day is joining in, Sandeep Bhatia, head of Equity India and country head India at Macquarie Group. Sandeep, great to have you with us on the show. Thank you very much for joining in. So, well, yes, the old saying goes that markets can stay higher a lot longer than the mind can stay rational. I don't know if we are in that scenario yet or not. But what do you make of things? I mean, this exuberance at the index level, PSUs, CapEx, the whole construct and structure at this point.
Yeah, it's a lovely monsoon outside my window, and it's a lovely market in front of my screen. So fantastic.
Lots of green, right? Outside and on the screen.
Correct. So just to answer your question, yes, I think we are at very rich valuations. I think in the near term, these rich valuations can sustain. Some of the data which is coming from the US is talking about inflation coming off. Our view has been that structurally there are three markets which are in a bull run, US, Japan, and India. not in that order necessarily. So I think, yes, India is on a good wicket and continues to be on a good wicket. The only thing which actually makes one pause and think is that I think earnings, while strong, I think the earnings revisions will be actually peaking out in this year. So if we don't see earnings revisions, there's definitely going to be headwinds, post-budget, and thereafter there could be definitely some headwinds. But it's not unless there is a black swan event, which is unpredictable by its very definition. We are in a good market, which can give you still around single-digit returns till the end of the financial year.
Okay, Sandeep, looks like, the monsoons have sort of uplifted your mood as well. I mean, good to see you, good to hear from you after a while. Thanks for joining us. The sector that everyone's talking about now is IT, primarily not because of the growth, but mostly because it's been such a laggard and now things don't seem as bad as they were about 12 months ago, right? Do you think it's a good time to be increasing your allocation in IT, especially after what TCS reported?
Yeah, I think you hit the nail on the head here. And clearly, I think IT is not being a favorite sector. There are many reasons for that. It's the US political cycle, it's the US interest rate cycle, it's the domestic economy growing fast. So why would I want to play, international IT spends, so on and so forth. We just discussed in the answer before that I think domestic earnings upticks are going to get difficult. And interest rates in the US can come off. So I think IT is good to play. We like Persistent, we like HCL Tech, we like TCS. So yes, would stick with broadly the larger cap names.
Okay, hi Sandeep. Good morning and good to see you in. This is Nigel on this side. Well, I recall you were quite positive on private sector banks, and HDFC Bank, I think you had hinted that it could be the dark horse. It did very well, from March till the last week. The stock was one of the big outperformers. From its low in February, it was up more than 25%. But now it's pulled back a little bit. What's your take on HDFC Bank? Because that got the technical factor moving for it. But the operational
Nigel, you have
update
a great memory. Thank you.
Yeah, but the operational update wasn't that great.
Yes.
What do you do with it? Is that still a stock that you would believe will do well from here on, and most of the bad news is in the price?
So the technical factor in favor of HDFC Bank, which is the MSCI inflows, we expect around $4+ billion to come in at the end of August. That technical event still is still to happen, and that should happen. So that will definitely be a technical reason for the stock to move up. But you're asking about operational fundamentals, business drivers. So I think here, it shouldn't be a standout negative outperformer. There have been issues around its tech, which has basically dampened the spirits. It's not seen to be the unsinkable stock that it was. It's still very much an unsinkable bank, but definitely not necessarily the unicorn kind of a stock. So I think in the banking sector, I would still be positive on HDFC, but we currently do like Axis and IndusInd Bank also. So we have moved a bit away from our extreme overweight we had when the stock was down in the dumps on HDFC Bank. But I think there is also a value to come through in the public sector banks. So we like SBI. And if this interest rate cycle, and we have a broadly responsible budget on the 23rd of July, if interest rates are seen to be coming off both in India and in the US over the next 6 to 12 months, I think both public and private sector banks can potentially do well. One thing is for certain, the investment, the NPA cycle and the bad debt cycle, we are not seeing any of that. So the broader economy, the credit worthiness of businesses and individuals remain very strong. So banks should outperform.
Okay, so still positive on banks, but maybe a little bit of a favorable tilt towards the PSUs like SBI. Got it. Just to clarify that point, you said that the market may still give single-digit returns by the end of this year, or are you saying 2020, end of the financial year? Okay, okay, got that. So, now I want to really draw your attention to, I think, the biggest momentum trade, should I call it investment or trade, or, that we've seen in the last many, many years. I wasn't around in the late 90s to see the IT move, but I saw the infrastructure trade between 2004 and 2008. And here we are looking at the mother of all PSU, CapEx sort of themes and that big trade. What's your sense? Where are we in it? Does it still have legs and room? Because there's no point betting against it. Anyone who's been betting against it has been absolutely left out in the cold. So what should we be doing now?
I think great question. Comes down to the simple fact that India's corporate sector has time and again made a mess of its banking sector. And both are completely interrelated. We saw that in the last down cycle in the markets. It started with IFL and it spread across, housing finance companies and so on. The corporates were anyway over-leveraged going into that bad event. But now, as things today, I think both in terms of the scrutiny, supervision from the Reserve Bank, and the fact that the promoters are assured of one thing, is that they will definitely face the NCLT and they will be stripped of their assets before they can strip the assets from the companies. And that means that generally the corporate sector is seen to be more kosher in its capital investment decisions and not get over-leveraged like it did in all previous cycles since the 90s when India liberalized. So to cut a long story short, yes, infrastructure boom is happening and should continue to happen. The only thing I will say is that look out for the macro and look out for the bad debts if they build up. Then this infrastructure boom can come off for both PSUs and in the private sector and in the real estate sector and across the board. That's not happening as we have already discussed. Credit worthiness both of corporate and individuals remains solid. Going into the next couple of quarters, and we can continue to play this.
No one's arguing against that, Sandeep. My question is more from the point of view of just PSUs, and I don't know. I mean, is this beginning to look like a bubble, or is it still justified because some of the companies are still reporting decent earnings, but stock prices have run up 300, 400, 500%. So specifically on PSUs, is there something that you would still back?
Other than the PSU, the banks, I would be careful about this. But, honestly, Macquarie coverage is not as wide in that sector. So for me to say something with solid research backing is going to be a bit difficult. So the PSUs are richly valued. They came from an extreme undervaluation now to historical highs and never seen before highs. That can continue as a liquidity event. Fundamentally, unfortunately, given our no coverage on those names, it would be difficult for me to actually give a view.
Okay, by the way, the market is really piling on the gains now. I mean, just look at that. 100 points higher on the Nifty, almost 300 points higher on the sensex. And lots of individual stocks, right? Our ONGC, by the way, is at a fresh 52-week high. So keep an eye out on that. Federal Bank is at a fresh 52-week high as well. And a couple of other stocks. Zomato we spoke about. That's been doing quite well this morning. And then you have some of the other names. Sandeep, before we let you go, the big event upon us is the union budget. And this time around, the common narrative is that given the higher RBI dividend, given, there's more fiscal headroom, perhaps the government could please everyone with, a growth-oriented budget, maybe some populist measures as well, and keeping the fisc in check. Do you think that's something that the street has priced in already?
When you try to please everyone, in the end, you please no one. The faster we realize that, the smarter we will be. So to answer your question, I would think that this would still be a fiscally responsible budget. There is no real pressure to do anything, even though there are some important state elections coming through in November, December. I don't think giving something in the budget can change the outcome on elections in any of the states which are important to the BJP. So I would expect it to be a fiscally responsible budget. If it is actually seen to be a populist budget and giving away freebies right after the elections that just ended less than a quarter ago, just last month, it would actually show weakness in the government. So I would actually look out for that and take that as a negative message if there's populism.
Okay, Sandeep, have a great weekend. Always fun speaking to you and trying to understand which way the market is headed. So hopefully we'll speak again soon. But good tidings for the market right now. The Bank Nifty is up almost 200 points. So it's been a party on Dalal Street. And as of now, it doesn't look like the party is ending. It's time for our special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from each sector. Today, Nigel has hopped across to the wall to tell us about the metal sector and what you can expect. Nigel, over to you.
Well, that's right. For the metal space, let's break it up into ferrous, non-ferrous, as well as miners. Now, the ferrous space, the EBITDA will see a sequential weak showing because of pricing as well as volume. While the EBITDA of the non-ferrous companies, well, it will increase because we've seen a sharp surge in base metal prices. For miners, we could see a bit of mixed trends that play out. Well, let's take the ferrous space first up. The EBITDA is likely to decline by around 5 to around 13% because of lower volumes and lower flat product prices. But all companies will see at least a $10 to around $25 per ton benefit because of lower coking coal cost. Volumes, well, they are likely to decline across sectors. That's in the range of around 1.5 to around 15%, with SAIL reporting the highest decline. Let's turn our attention to the EBITDA per ton then. For ferrous companies, well, they shall report a bit of an improvement in the range of around 100 rupees to around 800 rupees per ton. But JSPL, that's the outlier. That's expected to report the highest uptake in the EBITDA per ton because of the uptake that we've seen in long product prices. Also, in addition to that, there's going to be a relatively lower decline in volumes, and JSPL will also get some benefit of captive thermal coal, which will kick in. On the flip side, though, Tata Steel's EBITDA per ton for the India operations, that will decline because of adverse operating leverage. That's about the ferrous space. Let's turn our attention to the non-ferrous producers then. They are likely to see an EBITDA uptick because of the improved LME prices. Vedanta, that's the one to track. It's likely to clock an EBITDA uptake of around 16% on a sequential basis. That's going to be driven by higher zinc as well as aluminium prices. It'll partially be offset though because oil has been a little bit weak and the oil and gas volumes on the whole have been a little bit weakish. Now, Hindalco's EBITDA is likely to see a 14% sequential growth because of improved aluminium prices, which are up by nearly around $300 to around $330 per ton sequentially. But that will be partially offset because in the previous quarter, the copper profits were much higher. So partly offset on that front. Novelis, though, will be crucial to watch because they are likely to report EBITDA per ton of around $525 per ton, which will be 10% higher on a year-on-year basis, but a little bit lower on a quarter-to-quarter basis. Finally, let's turn our attention to miners. We'll like to see mixed trends as NMDC's EBITDA per ton can increase by nearly around 19% on a year-on-year basis because of the sharp uptick we've seen in pricing, which will be partially offset by lower volumes owing to that miner strike, the worker strike that we saw in May 2025. Coal India's EBITDA, well, that will decline though by around 7% year-on-year because of lower realization from e-auction, partially offset by higher volumes. And finally, GMDC, well, they shall post a bit of an EBITDA decline because of lower realizations, but that as well will be offset because volumes could improve. They had reopened one of their mines, which will help them on the volume parameter.
Okay, got it. So basically, ferrous a little subdued, non-ferrous firing away, and the miners not so bad. In a nutshell, yeah?
Well, that's right. That's right, Survi.
All right, you come right back, Nigel, because we're going to take this forward with Amit Dikshit, who's been tracking the metal space for such a long time. He's with ICICI Securities. Amit, great to have you on. So let's start with ferrous first, where Nigel told us that maybe it's not going to be the hottest quarter in terms of, volumes and the way spreads will shape up. What is your sense? I mean, how bad could it be really? And is this just a one-quarter blip? What's your view on stocks? Ferrous first.
Yeah, hi. Good morning. Hello.
Yes, Amit, we can hear you.
Yeah. So the way we look at the ferrous space is that what we have seen is a dichotomy between HRC prices and longs prices. So HRC prices have been on softer side. In fact, April and May were good months, but June saw a little bit of decline. In case of longs, although headline prices look very strong in the quarter, but it was only limited to rebars. The other longs, such as wires, beams, channels, etc., didn't show that much increase. Now, most of the steel companies, they don't sell only rebar. They sell a mix of all these products. So therefore, to that extent, the increase in realizations would be relatively muted.
In fact, we expect that there would be a flattish increase in realizations. Of course, the realization would go up the highest for JSPL in our view because of its exposure to long products and sale. Having said that, coking coal prices come as a respite, although the big benefit in my view would come in Q2. So coking coal prices, as per our estimates, will be lowered by $15 to $25 a ton in this quarter. And that also depends on company to company. So all in all, what you will find that the EBITDA per ton, if I compare it with last quarter, and last quarter, mind you, was Q4, where typically volumes are the highest. So there is a little bit of adverse operating leverage in play also over here. But having said that, volumes of JSW steel and SAIL are likely to remain flat QOQ, while those of Tata Steel are expected to decline a bit, mainly because of certain one-offs in last quarter and the fact that they don't get that much advantage of lower coking coal prices being integrated, partially integrated. JSPL is one of the companies that will show the highest bump up in EBITDA per ton.
Okay, all right. Hi, Amit, and good to see you and good to speak to you after a while. From the ferrous pack, what's your preference at current prices? Give and take everything. The volumes, the backward integration, the changing mix. At current reckoning, which is your pick?
So ferrous space, our preference is actually, if you ask, number one preference is Jindal Stainless. And the reason being that if you look at the volume uptake, that is going to be the highest over there. In fact, the volumes from Q4 would hardly go down. So Q4 volumes were the highest. And in Q1, we will see around the similar volumes. EBITDA per ton is going to go up for Jindal Stainless. So therefore, what we expect to see the improved performance and going ahead also, because of a converter-based model and nickel prices forming up, we expect to see EBITDA per ton moving to that 20,000 per ton range. After Jindal Stainless, our preference would be JSPL because of the traction we have seen in longs, and after that JSW. So these are our three picks in ferrous space.
Okay, got it. Okay, so we have JSPL as well as Jindal Stainless. Both those two you like from the ferrous pack. What about on the non-ferrous space, Amit? What's your view on Vedanta? People are getting a little bit cautious that promoter entity came and sold twice. Now there could potentially be a QIP. But Mr. Agarwal knows that his stock price has moved up. Why do be, dependent on banks? He's saying, let's take some money from the equity markets itself. What's your view on the non-ferrous space and particularly Vedanta as well as Hindalco?
Yeah, so starting with Hindalco. So in case of Hindalco and Vedanta, both of them will benefit from the firm LME aluminium prices and of course, zinc prices that is more relevant for Vedanta and Hindustan Zinc. So what we expect to see that in case of Hindalco, the aluminium EBITDA would go up. However, in Novelis, we expect that because of firming aluminium scrap spread, we would see that EBITDA per ton would be down slightly QOQ. So in case of Hindalco, we expect that EBITDA would go up by around 11% QOQ. Now, in case of Vedanta, what we see that it is the biggest beneficiary of base metal, of the surge in base metal prices, because its exposure to base metals is highest not in India, but in the world. So clearly base metal prices going up benefited, but alumina prices also going up in tandem actually might be a little bit of a disadvantage to the aluminium division. Having said that, the higher LME prices would kind of, negate all that. And we would expect to see a good performance. Now, on the zinc front, yes, of course, we would expect that because of LME zinc prices also coming up, things should be great over there. So Vedanta, I think, is in a purple patch as far as this quarter is concerned, because not only prices are supporting, but also volumes are ramping up, particularly at aluminium and zinc.
So you're positive on Vedanta at current levels or not? At 450 rupees, it's going to be the biggest beneficiary, as you said. Vertical wise, you have different opinions. But at 450 rupees, would you be a buyer?
Sorry, Nigel, we don't have Vedanta under formal coverage, so I can't give a recommendation on this.
Okay, then give us at least a rough valuation, because they have been talking about selling that steel division. And Mr. Agarwal is expecting the mool. When he spoke to us, he was talking about very, very high valuations. He said, if I don't get a buy, I'll continue to run it and expand. But if you had to give it a valuation for that 1.5 million plant that's moving all the way to 3 million, what should the rough, realistic value, according to you, that they should get?
See, again, it depends on the market, depends on a lot of factors. Having said that, I believe that the real valuation of that steel plant will not be 1.5 million tons. It would be when Vedanta would be closer to 3 million tons, because 3 million tons is an optimal size of any steel plant of that particular product profile. So, in fact, for a 3 million ton plant, well, we are seeing the valuations, in the, I would say, in the country, in Naganar is also on the anvil, and we are kind of hearing some kind of valuations over there. Having said that, in case of Vedanta, if you look at it, assuming that it's a 3 million ton plant, I would value it somewhere around, I would say $700 to $800 per ton in the current scenario.
Sure. Thanks a lot. Thanks a lot for joining in. We have to take a short break on that note, but up next we have an exclusive conversation lined up with the TCS top management. Stay tuned for that. Welcome back. This is Corporate Radar. For now, the market is actually doing very well. 100 points higher on the Nifty. A lot of stocks are off their lows. A lot of stocks hitting fresh 52-week highs as well. Just wanted to point out that the banking space is now picking up and providing the support that the market needs. And oil and gas is really the sector to watch. Oil India, ONGC all at fresh highs. But TCS kicked off with IT earnings season, beating street expectations in the first quarter. Prashant and Rima sat down with the top management at TCS. Listen into what they had to say.
Well, that's right. We have the top team at TCS with us to talk about the numbers and, of course, what FY25 now looks like, that we're sort of officially kicked it off with the first quarter numbers. We have K. Krithivasan, CEO at TCS. We have Samir Seksaria, CFO at the company. We have Milind Lakkad, who is CHRO at the company. Gentlemen, great to have all of you here, as always. Thank you very much. Krithi, if I can start by asking you, you've always told us two things over the last couple of quarters. One, FY25 is going to be better than FY24. Although you've not put any numbers to it, I hope we can change that today. And second, you said that customers are continuing to prioritize projects with the highest ROI.
That's right.
And they're kind of sort of a little soft on discretionary spends. Just talk to us by sort of giving us your perspective now that we're at the end of the first quarter. You've reported a 2% plus kind of constant currency growth, which is better than what the street was expecting.
Thanks, Prashant. So we are consistent. Okay, FY25 is still whole will be better than FY24.
Right.
And we are quite comfortable with that. And see, what we have not been able to see much of a change in customer behavior in this quarter compared to the last quarter. They are looking at cost optimization, opportunity to do more conserve cash, and if there is a continuing trend towards looking at the ROI, so all those none of those factors are changed. And but with that, like you saw our numbers, which we are quite happy about, so we're comfortable with the fact that it will be better than FY24.
So this pickup in growth rate that we've seen in the current quarter, is it because of execution of large deals like BSNL, the typical seasonality, or is it that we are seeing some signs of pickup in discretionary demand? Is that present in the Q1 numbers and the growth rate?
Definitely, like the first point you mentioned, pickup in work in deals like BSNL is definitely one factor. The second is not necessarily the discretionary spend, but more cost optimization spend also. That's as an increase. So both together is what is delivering this.
So there's still no pickup in discretionary demand, or is there any visibility that...
See, like there's no deterioration.
Okay.
But there is no visible pickup to say that now things are back.
So let's nitpick about the 2.2% number a little bit, I mean, if you will allow me. So what, adjusted for the BSNL deal, what would that number be? Because there is a 600 crore increase quarter on quarter in that component, cost of equipment. So what will the, adjusted for that, what will the sort of CC number be?
I will not pick up a project and call it out. But I think if you look at the numbers on the segments which are reported, both from a geography and markets perspective, the growth is very broad-based. When you're looking at sequentially also, if you calculate it, while we don't report the sequential numbers, it is all geographies have been positive growth. And all verticals except one, CMI, which continues to be under pressure, have seen positive sequential growth.
So would it be like close to, I mean, that's almost 1%, right? We're talking about. I mean, if you want to adjust it, you think one should look at it like that? What's the
maths could be here and there, but overall, the 2.2% is there. There are quite a few markets which have grown above the average and at 2%, versus some of the major markets would be around the 1% mark. Amongst the verticals also, sequentially, at least 2 to 3 verticals sequentially are about 3%, around the 3% mark.
Samir, on margins and the margin performance this time, a couple of questions. One, is there a decline in a reduction in the wage increment that you've given your peers? Is that something that explains the improvement in gross margin? And two, on subcontracting costs, there is a decline. But it's at very low levels now, I think 4.5%. Do you see that increasing, the subcontracting expense? And third one, what can exit margins be? Because typically from Q1 to Q4, you see an acceleration of 2.5% plus or minus. That pegs you with exit margins of 27% plus for FY25.
I hope it was always as easy as that, but let's take it.
Historical
let's take each of the questions. So first one was on the wage increments. We had a 170 basis points impact on account of the annual wage increase, which we gave typically at the beginning of the year, and as usual we have done that. And in the past, it has ranged between 150 to 200 basis points. So it's bang in the middle of it. So it's a usual impact coming in. Second, on the subcontractor expenses, it's at 4%. Yes, it's been a decline. I called it out. We see it bottoming out. I do feel it would bottom out, but it would also depend on how the overall demand scenario plays out, and how the supply scenario. So typically subcontractor is short-term demand supply mismatch, and if we need to optimize it, we still have 4% to optimize it. But relatively, as I had called out last time, we would expect it to be stable around this number, but depending on the demand.
Q1, sorry, please.
There was one more question. Exit margin. Fair. So we are happy with 24.7, and that's 150 basis points, as you rightly called out, from Q1 last year. And I think we have taken the biggest headwind upfront. And last year, our operational discipline and execution rigor ensured we had almost 100 basis points operating margin improvement in each of the quarter. We hope the journey continues.
So
27% plus, is it?
At 24.7, we are glad. We expect, typically we claw back the margins as we go into. It would depend on multiple factors. So
Q1 and Q2 are typically the sort of the strongest kind of quarters. And as Rima said, I mean, through the course of the year, would you be able to? I mean, is there visibility for you to
claw back margins and move up, inch upwards from here on?
Northwards of what? I mean, by.
I hope I had crystal ball.
But I mean, Kriti, you want to weigh in on that?
Yeah. We've been talking about our aspirational range of 26 to 28. We will try to get back into that range. We don't want to set a target or give a guidance on whether we will reach 27.5. We'll be happy if we can reach there. But our aspirational range will be 26 to 28. So we need to weigh in other business factors and market conditions. So, but we'll continue to.
Is it going to happen from external factors? I mean, levers that you can use in terms of pricing, etc., or is it sort of cost control internally?
Both, right? Like cost control, you can do only so much. So we need to depend on pricing factor also. We look at both options. Like it could be pricing, it could be mix of product, it could be leverage. So many other levers are also with us to manage that.
Milind, the increase in the number of employees by nearly 5,500, is it because freshers typically come in Q1, or is it a sign that you've had 3 quarters where the employee headcount has declined? Have we come to an end? And what's your prediction or expectation on how attrition pans out from here?
See, I'm very happy that we have 5,400 plus addition. I think it's a combination of both. It's not only freshers, it's freshers and experienced hires both. Going forward, how does it happen? Depends on various factors. We obviously wanted to basically have this number higher as because we want to basically invest like we all did in the past, right? And campus hiring is something which we will anyway do, and that will anyway happen. That is our core strategy for TCS. So that will happen. So net number where it will be very difficult to say, but campus hiring will continue.
Okay, and attrition?
Attrition is at 12.1.
No,
which is,
where do you see it headed?
I said 30 basis points. We did 40 basis points. So I expect this to now be stable at this number point.
Preeti, just a quick word on the US, which is of course the big market, the big geography. I just wanted your sense. We speak with economists and market watchers and all of that. I mean, all the time. But I wanted your sense as someone who's operated in that market for such a long time, and you really know what's happening there. Are things getting better, or because we are also hearing that things are actually slowing down very rapidly now? It's under the surface, but it's slowing very rapidly. The commercial mortgage market, for example, etc.
My view, Prashant, it can change from industry to industry also. The interest rate regime is one overhang, elections another overhang. What we understand from our teams is, for instance, telecom vertical, which is stressed for quite some time, which is very capital intensive. With the reducing interest rate regime, maybe there could be more investment that can happen. So it can vary. But other point to look at is, like, while there are enough overhangs there about new discretionary spend, we also believe there is enough to pick up on cost optimization. We do go to our customers with new propositions on how they can optimize the cost, and it can increase our revenue pie also. So I don't want to depend too much on macroeconomics alone. Like, I think there are enough levers outside of the customers still want to do certain things around cost optimization. So we want to go after those opportunities.
When we speak with IT analysts, etc., they say, well, the bottom is here. Growth will start to rebound. Maybe it's 1 quarter, 2 quarters out, and that's it. Now we start to,
I don't want to get into this crystal ball gazing at this time.
But do you think we are at the bottom, or close to the bottom, in that sense, in terms of demand, real demand for services?
I'll be happy if it is true, Prashant. I don't know.
What's your sense? What's the best? What's your best sense?
That's what I'm saying. I don't want to go by macroeconomic situation. I want to go by what the opportunities out there are.
Okay.
And the opportunities, as I said, like, if customers are not spending on discretionary and they are interested in cost optimization, we would love to go to our customers with more propositions around how they can optimize their cost.
You mentioned telecom. Any other sectors which stand out to you, which looks promising?
No, telecom, I gave an example. Whichever sector is more capital intensive has a immediate impact on the interest rate. Like what happened even on the banking. Earlier days, because of interest rates, they were doing quite well. But over a period of time, the cost of deposit has gone up and the spread has almost vanished. So even now, most banks are going towards fee-based income instead of interest-based income. So it keeps changing over a period of time, because once you live in a particular regime for some time, the whole ecosystem stabilizes around that.
So talking about the opportunity, right? Your TCV, your total contract wins, are slightly lower than what we've had in the prior quarter at $8.3 billion. Is there anything to read in that?
We don't know. We don't read much, because we mentioned many times that our comfort range is 7 to 9 billion.
Okay.
And every now and then you get something lumpy, it goes beyond 10.
Got it.
And other thing we look at is what's our overall pipeline. Our pipeline continues to be very healthy. And whatever TCV we declared last quarter, we've been able to replenish in the pipeline. So our pipeline is back to where it was. And there's more a question of timing. The TCV is more a timing question. It always will be lumpy, and any mega deal comes, it will skew it. But
and what's the AI pipeline? I remember last quarter you all shared a number of $900 million.
1.5 billion.
$1.5 billion.
Yes.
That's a phenomenal growth rate in the AI pipeline.
Yeah.
Okay. And how is the conversion of the AI pipeline into deal? Is that also getting a lot of scrutiny?
We are at this stage. We are looking doing close to about 270 projects are being executed.
Okay. And in that, is it possible to give us some color on the Gen AI pipeline or the deals that you've executed in value terms?
You can do that, Rima, but our view and what we have seen in the last couple of months and quarters is more and more projects are getting integrated. Like you are able to get value only when you do a traditional AI along with Gen AI is where you get the value. Pure Gen AI gets a very limited value. So there are data programs that get initiated, there are traditional AI programs that get initiated, and Gen AI. So it's a combination. Actually, you're not going to gain much by saying how much is traditional AI, how much is Gen AI. Because we are proposing to our customer the integrated solution.
270 sort of projects essentially. I mean, that amounts to what? What's the transaction? What's the total value?
Publishing the value of those projects.
Okay, but obviously, I mean, the number that from last time that we spoke, the pipeline is growing at a very fairly fast clip.
Yeah.
And I mean, any sort of visibility in terms of projections for the pipeline at what is it going to continue with this?
So we are going to our customers with many opportunities, use cases, solutions. So every business unit is doing that. Every geography is doing that. I don't think we are going.
And margins are comparable to for this kind of work.
Very comparable. Very comparable
to company averages.
Exactly.
There is a bit of a concern that the Gen AI pipeline or the AI cloud data pipeline is crowd.
Here. I'm not in.
I'm
including only traditional AI and generative AI when I say.
Is that $1.5 billion?
Yeah.
But I was reading Salesforce, for instance, when they came out with their numbers. So some of the US software companies are talking about reprioritization of tech spends towards AI, cloud, and data. And that might hurt, and that's the analysts in the US are reading it as it might hurt the traditional IT services companies because of crowding out of the budgets because of this. So while it will benefit you, but it'll benefit, say, the hyperscalers a lot more. Is this something that you are seeing?
See, it will benefit them. It will benefit because it benefits us also. Because typically the rule of thumb is if you are doing.
Will it hurt IT service? Will it slow down the growth?
At any point in time, as you spend more on cloud, more on AI, more on Gen AI, there will be less and less spend on the very traditional. But you also look at you have to move workload from your traditional infrastructure to the cloud. So that's going. We cannot expect people to be working on traditional infrastructure when they are also spending on cloud. Overall, we don't believe it hurts us. It's good for us.
On BFSI, what is the outlook since that's a third of your revenues?
See, we have done, as he was saying, almost all verticals, all geographies had a positive growth this quarter, which is a big relief. And BFSI, I think, is also sort of North America has done better than BFSI. North America has done better than BFSI Europe. So, which is again is a good thing for us. For a long time, we've been having that was under stress. So, North America BFSI doing well is a good thing for us.
Okay.
Any other geographies you want to call out, Kriti, which are
obviously our overall regional geography has been doing very well. India is doing very well. APAC is doing well. Middle East is doing very well. So the diversification of into the regional geographies is playing. Currently now, sum total has become a very material segment for us, and the growth we are seeing is very gratifying.
I'm going to ask you one more time. It's a slightly top-down macro-ish question, but I think that is what really investors want to know. Are we at the, can I put it another way? But my question is, are we at the bottom in terms of tech spending? I don't know if I can ask you this, Samir, because Kriti is not giving us an answer. What's your sense?
See, our focus is, we know our business. Probably the economists can tell better. Our focus is to stay close to our customers.
I'm not talking about macroeconomics. I'm talking about IT spending, spends from IT services, because you talk to clients, you get a sense from them. It's not happening.
Let me take what we are. If you ask me what is the tech spend by and large has been flattish. Okay, will it go from here? We need to see. It depends on overall market sentiment. But it's remained flattish for the last couple of quarters, and we are going about our business based on where is the customer wanting to invest and what customer priorities are. So, as I said, we've been waiting on looking at is the market going to turn up or not for too long. We want to now focus on our customers and see what they want.
Which you've been doing very well, and that's why we are seeing the kind of growth that we've seen. But my only point is that it'll get this tailwind if market sentiment also picks up. And that's my question. Is it picking up? Are we at a point where things start to pick up, or you don't have that visibility yet?
We don't have the visibility. We don't also want to depend on that too much. That's a view we are taking. Let's we know what our customers want, we'll do what our customers
And what
want.
about leakage from existing discretionary projects, which was impacting growth? Is that continuing at the same pace, or has it slowed?
Well, there is because when they continue to reprioritize. See, what happens is they usually get the low-hanging fruits, right? After that, when the continuing next $10 or 10 million spend happens, they look at, is it bringing commensurate benefit? If it's not, they would rather spend that the capital somewhere else, right?
I just one final question from my end. Is this something that you're seeing when you go out and bid for deals? Because some of your peers have lowered the margin threshold. So while you've never had to trade off growth versus margins, but are you seeing some of your peers getting more competitive because margins in the industry have come down? Not for you, but in the industry. So is this something that you're seeing?
It is a competition. See, usually when you are in a low growth environment like this, it is competitive. Okay, people want to grab as much market share as possible. So it is a tough market out there. But you again, as I said, like you go to an existing customer, they know what you can do, and what you have done in the past. So you have to provide overall value here to gain the margin as well.
Welcome back. You're with us, and we're looking at commodities now. We've got Manisha Gupta joining in. Manisha, apart from the monsoons, which are really bearing down heavy on the city, what else are you tracking today?
Well, I'm looking at the crude oil prices. This is another thing that has been trading quite on a firmer note. If you look at the month of June and the quarter of June as well, that was on the positive side. And the crude oil prices right now also are trading at a 6-week highs. This is because of the strong demand that we've seen coming from US. When you look at the US gasoline demand, that has jumped up quite strongly. It's at a 2021 highs right now. And that is because this is summer driving season demand in US. And it is anticipated that it is going to be 20% higher than you saw in the last year. Also, the US jet fuel demand is highest since January 2020. So that clearly has shown in case of inventories as well, which we have seen declining in last 3 weeks itself versus a bit of a gain that the markets were anticipating. So all of those factors in sense of online demand, on-ground demand have been on the stronger side. Also, when you look at the US markets, well, the WTI is trading at the steepest premium to the next month contract. That tells you that the demand in the current month is very high and people are ready to pay premium for the crude oil prices. So it clearly is a contango and a very big one at that. And that really seems to be supporting the markets there. So we have been holding around that 85 to 88 mark in the Brent prices. And as far as the WTI goes, it has been holding above $80 a barrel for some time now. The US inventories, as I said, have been on the higher side as well. We have seen constant declines coming in for this one. That has been supportive. Also, when you look at the international markets, because of the recent hurricane, there are still some supplies and facilities which are offline, slowly coming back into the markets. But that's a premium that the street also has been looking at. The recent reports from OPEC and EIA also suggest that you are looking at demand growth in this year and the next as well. EIA also has put a report suggesting that in the next year, the demand will outpace supply for 2025. So that price also seems to be adding some premium right now into the markets there. And then look at the kind of economic data that we have seen that has been supportive. The US inflation cooling for the third straight month in the month of June to 3% has been supportive. The street is now anticipating and looking at an almost 85% probability of the first rate cut coming in the month of September. Well, that has been supportive. We also have seen a decline in US dollar index, the treasury yields, and that has been supportive. And then, of course, it has been about the Chinese data, where the property sector is not doing so well and the imports have kind of declined as well. But the export markets clearly seems to be jumping. So that tells you that while the domestic demand in China is not picking up, but the world over rest is, and that clearly has been supportive yet and again for the industrial commodities.
Okay, thanks a lot, Manisha, for that. Well, let's do one thing. Let's take a quick break on that note. On the other side, we bring you our exclusive conversation with RBI Governor Shaktikanta Das. Stay tuned.
Hello and welcome to the most important interview for the economy. I have with me Governor, Reserve Bank of India, Mr. Das. Mr. Das, thank you very much indeed for giving us time. Really grateful for this. Now, everyone, every viewer, and today the viewership is like really teeming, would want to know about interest rate cuts. Please don't tell me aligned to the target, inflation aligned to the target. We heard that. After that, we've had, Powell saying that we cannot keep rates too high. We had an ECB cut. And much more important, domestic core inflation has come below 3%. So what would you guide?
I'll be very forthright. In fact, it has made my endeavor and effort throughout to be as forthright as possible and not to sort of try and camouflage the real issues by giving some, some generalized kind of reply. Now, when you talk of interest rate cut, now, of course, everybody always, at any point of time, everybody talks about interest rate cut. There is another whole lot of people who are the depositors, the silent depositors, who are, who would be affected in a different direction. Now, that is one aspect. Now, when the inflation is at 4, our inflation, the last print was 4.7%. And the June inflation is expected to be, out tomorrow. That is also expected to be, as per the surveys done by various wire services, that is likely to be close to 5%. So when we are at 5 and our target is 4, I would feel it is too premature to talk about interest rate cuts. Now, some central banks do some kind of advance guidance saying that, it is not far away, or, we are getting close, something like that.
That was my ask.
Yeah, but the issue is the overall economic environment globally, not just in India, globally and in India, it is so uncertain to talk in terms of interest rate cut that I will do it, 1 quarter away or 2 quarters away. You say something and then you have to sort of take back whatever you have said today. So basically it is the uncertainty which is the one aspect. Second thing is the CPI headline inflation continues to be close to 5%. In fact, as I said, according to the surveys done, it's likely to be again expected to be close to 5%. So therefore, from that context, I think it is too early to talk about interest rate cuts. And I would rather not give, any kind of forward guidance, which may, I said it, I think, somewhere else. I would not like to give any kind of forward guidance which would lead the market players and the stakeholders and others to board the wrong train.
Okay. Now, I'll look at it this way. See, there were 2 MPC members who spoke about the neutral rate. Now, just a word to our viewers. The Reserve Bank and all central banks look at the difference between the interest rate, repo rate, minus inflation. That gives the real rate. Now, the real rate at the moment is 200 basis points. If you look at your 1 year ahead inflation forecast, 4.5, we are at 6.5. Now, what is the neutral real rate according to you? We thought we will get it in the bulletin. The MPC members think it should be 100 basis points. What do you think?
You see, with regard to neutral rate, let me use the word neutral because that is much more accurate. The neutral rate, first of all, as you know, RBI a few years ago, our research teams had done a study according to which the neutral rate was about 1.6 to 1.8%. Then immediately in the aftermath of the COVID, somewhere in 2021, our research teams in the Reserve Bank, they came out with a number which was 0.9 to 1%. Let's take it as 0.9 or 1%. Now again, our research teams are working. What is what is possibly a neutral rate? The main issue with neutral rate is that it all depends on which period you are looking at. Now, and neutral rate also is subject to so many structural changes which which happen in the economy. Now, let us say in between we had the COVID pandemic. So that had a structural impact on the economy and had an impact on the neutral rate. So neutral rate came down to 1%. The other uncertainty is that neutral rate also depends on what is the potential growth you are assuming. Because that is a very important determinant of the neutral rate. So it is whether your inflation is at target and whether your growth is at potential growth level. That is basically the place where your rates are neutral. Now, so therefore, it is subject to so many uncertainties. It is subject to so many structural changes. We did one analysis immediately after the COVID.
Now the next analysis is being done. I think it should be over in the next couple of months or so. Once that is out, once that is completed, we will release the number. Now coming specifically, if I can, answer your other part of your question. Now coming to, this monetary policy decision, etc.
They are saying 1%.
Yeah. You see, at the end of the day, neutral rate is subject to so many uncertainties. It is also a theoretical construct.
Yes.
Policy making in the real life, policy making in the real world has to be driven not by a theoretical construct, an abstract theoretical construct, if I can put it that way, but has to be guided by the actual numbers. And what are the actual numbers? The actual numbers here are inflation, at 4, whether we are at 4%, and growth where we are. Today, inflation is at 5%, headline inflation is at 5. We have projected a growth of 7.2. We are still quite a distance away from our target with regard to inflation. Growth is holding, is holding quite well, and growth is 7.2%. So therefore, you have to make, policy making is being made in the real world, and you have to go by observable numbers, not by a theoretical construct.
But would you say the economy is growing faster than potential, or is it growing at potential at this point in time?
You see, economy, when you talk about potential growth, I mean, this question also comes up, that is, what is India's potential growth? I think with regard to growth, what is important is not to look at the number per se, but to look at the direction of growth. I have said elsewhere, and it is just, I have quoted the facts, it's not as if I am saying anything new. The last 3 years GDP growth is an average of about 8.3%. For current year 24-25, we have given a projection of 7.2%. And there are many drivers of our growth which are playing out their role. The momentum of economic activity, the momentum of growth in the Q4 of last financial year, that is January to March, was very strong. And the momentum of economic activity in the in the quarter ending June, that is the first quarter of this year, also continues to be strong. So given this, I think 7.2% which we have given at this point of time, it looks very much achievable. And again, if you look at the, if you look at the growth from demand side or supply side, now supply side would be your basically how your industry is doing, how your agriculture is doing, how services are doing. In demand side, if you look at, let us say, how consumption is doing, the private consumption, public consumption, or rural and urban consumption, you look at investment, you look at your net.
That is running weak, no sir?
Sorry?
Consumption is running a little
Consumption,
weak.
let me tell you, okay, since you are asking me, let me put it this way. So far as the supply side is concerned, agriculture is expected to do well in the current year, good monsoon, and the season is looking good. Agriculture is expected to do well for the current year. So far as industries is concerned, the manufacturing sector is doing very well. The IIP numbers are very much in the expansion zone for a very, for considerable period of time, for past so many months. The latest IIP numbers are also, not IIP, I'm sorry, the PMI numbers.
PMI numbers.
I'm sorry, I mean the PMI numbers. The manufacturing PMI as well as the services PMI have, again, they're remaining, they are higher than what it was in the previous month. And services is doing very well from the supply side. In fact, our service exports have also gone up strongly. Overall, service sector activity at the moment is very strong. Now, coming to the demand side, you asked about consumption. Urban consumption has been quite strong for quite some time, and it is remaining stable. Rural consumption, which was lagging behind, has picked up. In fact, it was out there in the media that the FMCG sales, rural FMCG sales have picked up. And given the fact that we have an expectation of a good monsoon, and incidentally the NREGA demand has also fallen. And considering that we are expecting a good monsoon, and the monsoon is now very much active in many parts of the country, the rural purchasing power, thanks to a good agriculture, will also go up. So urban demand is holding stable, rural demand is picking up and is likely to improve. The third component on the demand side, as you would know, is the net exports. Our exports have picked up. Yes. Services exports are very strong. So if you put all these things together, I think what we are looking at is that India is on a trajectory of, higher growth. And I said it elsewhere that I think there is a structural momentum to our growth drivers, and we are moving towards 8% growth. What I have said is that we are moving towards that.
Yeah.
So therefore, I am quite sanguine about India's growth. Coming specifically to the potential growth rate, on potential growth rate, I would like to say it is the direction of growth, which is important, not the exact number, whether it is 7.2 or 7.5 or 7.7.
No, the 3-year average looks good also because the previous was a contraction. So you got 9.7 and therefore the average is high. I took a 10-year average, it comes to 6%. I took a 20-year average, annual is 6.5%. Do you feel in the next 3 years or so, we will be substantially higher than that?
You see, when you look at time horizons, you said 10-year period and 20-year period. In the last 10 years, there were structural breaks.
Yes.
Like COVID pandemic was a major structural break. If you take into account the last 20 years, you had some structural drivers by way of, let us say, reforms like GST, IBC, monetary policy framework, introduction of the MPC framework and all that. So that was a kind of a structurally, they were positive, but structurally negative where the COVID and the commencement of the war in Ukraine, then sudden squeeze in external sector demand and all that. But now we are getting out of it. So therefore, I think, again, a 10-year average and a 20-year average, you have to discount out these kind of structural idiosyncrasies or impacts and then look at the growth momentum. So far as our current scenario is concerned, let us say post-COVID, also, I think the growth numbers are gradually, the base, statistically the base factors, the base factors are also gradually evening out. They're gradually evening out. That's why you see current year 7.2%, not 8 point something.
But better than 6.5, you would say? I mean, since
certainly.
You expect in the next 3 years. Okay.
In fact, I would expect the, international agencies and others, I think some of the rating agencies have also revised their growth projections upwards. And some of the internal...
So more upgrades are likely.
More upgrades are likely. Even the international agencies also, which are expected to give their projections in the next maybe few weeks or months. Let us watch what they are saying. But I see clearly the upward trajectory, growth is on the upward trajectory.
Okay, then let me come back to the interest rate question. Is what one factor holding you back is the asset inflation, the perceived froth in the stock markets? Is that holding you back on rate policy also?
No, not so much. I would not say not so much, but let me say we watch all aspects of the economy, including the stock markets, more from the point of view of financial stability.
Yes.
What kind of spillovers it will cause to the overall economy. So we look at the stock market scenario, whatever is happening in the stock market or whatever is not happening. Basically the stock market scenario, by us, we analyze it from the point of view of, more from the point of view of financial stability. Coming to inflation, coming to rate hike or rate cut, coming to monetary policy, we are governed by our inflation growth.
By goods
dynamics.
inflation. No, I take your point. What I'm only saying is, does it worry you that you should not cheapen credit when the markets seem frothy?
No, so far as that's what I said. That is, we look at the kind of spillovers, the stock market, or for that matter, any development in any part of the economy, what kind of spillover it will have to the entire financial system and to the entire economy, whether it is stock markets or the bond markets or, so many components are there, so many segments of the economy. We look at what spillovers they will cause. Now, so far as the banking sector is concerned, we are very closely, we monitor all banking, meaning the credit sector or the credit growth, all that is, this segment is concerned. We very closely watch this position. In fact, much closely than it was, a few years ago, much more closely than a few years ago. And whenever we see possibility of whenever we see some early signs or whenever we feel that a few months down the road there could be a problem in this particular sector or subsector, we act. And an example is the unsecured credit where we took action
and you
last year
raised
in
the risk
November.
weights.
And we increased the risk weights and the results are there to see.
Okay, that's exactly what I'm saying. See, the F&O volumes was something that troubled government, RBI and SEBI. And SEBI has appointed the Padmanabhan committee on it. So do you have this fear that bank money could be fueling the stock market rally? And therefore, is there a case for higher risk weights? Or even to keep the interest rate, on watch?
You see, so far as bank money going to sort of create some, giving some boost to the stock markets, etc., is concerned, the exposure limits of the banks to the stock market, individual borrowings from, let us say, NBFCs, which were very high earlier for participating in IPOs or for going to the stock market, the IPOs or for FPOs, whatever, even there we have put a limit of 1 crore. It was all done some 2 years ago. It's not something we did yesterday. So therefore, at the moment, so far as from the point of view of the credit sector, there are no major concerns.
Okay.